Hey all, welcome to ShareTreck. This is Raj here. Friends, it was a great weekend. I took it a bit easy, but I also did a little bit of data crunching because just like you, I'm also looking for clues as to whether the bear market has started or not. And if a bear market starts, I think I'm well positioned right now. You guys have been seeing my portfolio. I got adequate cash available to dollar cost average. So in the quest for an answer to this question, whether the bear market has started or not, I started looking at a lot of data sets on the internet. I've selected a few of them here, and I'm going to walk you through it, and at the end I'll give you my conclusions and also my realization. So please watch till the end. I'll catch up with you after the disclaimer. Welcome back, friends. We are less than 80 days away from the 2024 US presidential election, and it seems that since 1928, the incumbent party remained in control of the White House in 12 out of 15 elections when S&P 500 was positive during the last 3 months leading up to an election. On the flip side, the incumbent party lost the election 8 out of the last 9 times when the market returns fell in the 3 months before an election. So the 3 months before an election we are looking at is not exactly a quarter the way we look at it. So the data is difficult to get, but I have looked at some reports by T. Rowe Price and by NASDAQ, and I've collected some of the graphs that made sense to me, and I've put together a story out here. So historically, the S&P 500 has not posted its strongest 90-day performance of the year leading up to election day. And based on data from 1950 and all the way up to the previous year, that is 2023, we have an average monthly return during that period where it shows that August has a negative 20% return, September has a negative 87% return, and October has a positive 0.75% return. And this is contrary to my feeling that the last 2 weeks of September are going to be bad and entire October would be bad. So I would assume that the last 2 weeks of September are the worst, and then things improve in October. That's the way I would read based on these historical averages that have been shown. And cumulatively, those 3 months have an average return of minus 0.32%. And the market's strongest 3 months from all the way from 1950 right up to 2023 are, the first one is April, where we have a return of around 1.45% on the S&P 500. Then we have November, which is 1.63%, and December, which is 1.36%. However, in any given year, market conditions, investor sentiment, and economic factors can vary widely. Therefore, historical performance, while providing a context, is not the best indicator of how the S&P 500 will perform on a year-by-year or a month-by-month basis. Now things get a little bit more interesting because there are 4 exceptions to this rule. The first exception happened in 1956 when the economy was exceptionally strong, and in 1968 there was a narrow victory for Nixon due to 3-way race. 1980 Reagan defeated Carter during the oil crisis, and the economy was facing a 13.5% inflation, but S&P 500 returned 6.9% in 90 days before election. And then we go to 2020, the pandemic had its effect, and there was a high unemployment rate, and I think the unemployment rate was close to 9%, I think 8.5% or something like that. And therefore, Biden got a chance to win, and Trump lost. So he was an incumbent president who lost. So the question then is, what is going to happen in 2024? But we haven't completed the quarter, and there is no way we'll complete the quarter before the election happens, because there will always be lead time. So right now, what do we have? We have low unemployment, inflation is coming down, expectations of a soft landing is still in play, it's not out of play. However, since August start, volatility has picked up in September, and S&P 500 has dropped 4.23% after the index surged 2.21 in August. Will the rate cuts cause a positive momentum for the market? I hope so. Well, the last 2 weeks of September and the month of October have historically historically been the worst. However, November with the average historical gain, as I said, of 1.63%, and December with a historical gain of 1.36%, which includes the Santa Claus rally, are yet to come to the rescue for the average portfolio. But that is not sufficient to let us know what the election outcome is going to be, and therefore we cannot use the election outcome as an indicator of how the portfolio will perform, because the quarter won't be over, and the policy impact from the winning president will also impact the market. So the question then becomes, what happens to the market if the incumbent party wins, or if the opposition party wins the presidential election? In that case, what we could do is we could look at the average of all the polls that are being conducted and see whether Trump is likely to win or Kamala Harris is likely to win, and then look at their policy proposals and then decide which sectors of the market are going to benefit and which sectors are going to lose. And therefore, we could then take some informed decisions on which stocks to buy and which to sell off. So that's the way I would look at it. And the health of US economy appears to have played an important role in whether the incumbent party retained the presidency in an election year. And in turn, whether the incumbent party won the White House seemed to influence trends in the market volatility before and after past election. So how do stock markets respond to US election? So I have some charts that I want to share with you. The first one is from T. Rowe Price, and let us look at this graphic out here. This chart has been taken from T. Rowe Price, and it is showing that the S&P 500 has historically performed worse in presidential election years as compared to non-election years. And the graph compares the average and median annual returns of S&P 500 during presidential election years. And for presidential election years, we have 24 of those years in this data set. And it compares it to non-presidential election years, of which we have 72 years in this data set. Lower returns in presidential election years shows that the data shows that both the average and median annual returns are lower in presidential election years than in non-presidential election years. And the average annual return from presidential election years is 11%, while it is 14% for non-presidential election years. Similarly, the median annual return is 11.5% for presidential election years and 14.7% for non-presidential election years. And the data is based on an analysis by T. Rowe Price using data from Bloomberg Finance. And the infographic out here emphasizes the past performance is not a guarantee of future results, if you read the fine print at the bottom. And the use of both average and median returns help to identify potential outliers and strengthen conclusions, especially when both values are positive or negative. Overall, the chart suggests that investors might expect lower returns in S&P 500 during presidential election years, but it's important to remember that past performance is not always indicative of future results. Other factors can influence the stock, such as individual investment decisions that you have already taken and you're likely to take based on various other factors like geopolitics, interest rate, and so on and so forth. Now let us see what kind of returns we have had from SPX. So this is a chart for S&P 500 index, and each of these candles is a monthly candle. So I'm going to take a measuring widget and take myself to somewhere around January 2024. So this is where we started, January 2024. And if I trace it back all the way, let us say up to 1st August 2024, we had a gain of 19.25% since the beginning of the year. But now if we come down to where we ended on Friday, we still have a gain of 14.10% on the books right from the beginning of the year. Not a bad performance. And as the previous data set that we saw indicated that during presidential years, investors should expect low returns in the S&P 500. So potentially we can see further drops. So this indicates that there could be more drops in the S&P 500, and therefore we could be heading into a more bearish situation. But overall, the index is still on a bull track, and for it to become bearish, it needs to fall significantly significantly. Whether it will fall or not, we don't know. But right now, we are still sitting at a gain of 14.10%, and that's really amazing. Now, the other thing that I found out is that S&P 500 tends to experience increased volatility around presidential election years compared to other years. Let me put up an infographic here and walk you through it. Again, this chart is also from T. Rowe Price, and as you can see, the graph compares the average volatility of S&P 500 during periods before and after presidential election to the volatility observed in other years. So the data shows that the volatility of S&P 500 tends to rise in the year leading up to presidential election, peaking around the election day itself. And after election, the volatility generally declines, but it remains higher than in non-election years for several months. So post-November, we'll have volatility still going on for a few more months, and the graph provides the average volatility for different periods before and after elections, measured as the standard deviation of S&P 500 returns. And for example, the average volatility 1 year prior to the presidential election is 16.9%, while it is 16.1% for the same period in the other year. So there's a 0.8% extra out there. The data is based on an analysis by T. Rowe Price using data from Bloomberg, and basically their disclaimer says that the past performance does not guarantee future results, which means that we can take this only for an indication, but we should not expect everything to conform to this going forward, because averages are always something that tend to show the overall trend, and we cannot exactly depend on averages, but it gives us a context. In this case, I'll give you an example from real estate. So we have data coming from our real estate board on a regular basis, which gives you the average price of a home in Toronto, for example. And that average price is something that you may not actually find in any listing that has been sold, because that's the average of smaller house, like you have separation, detached or freehold homes, condo townhomes. So we have average for each of these category. Let's take the example of a freehold detached home. Let us say the average says that in Toronto, the average sales price of a freehold detached home is 1 million. That just gives you overall context when you compare it to the previous month average to see which direction everything is moving in. But the weightage inside there for various instances of sales would be different. In a given month, a lot of smaller detached homes would have sold, and they would have sold for a lower price, and very few big detached homes would have sold, and they would have sold for a higher price, but the overall average comes much lower. And in the next month, there may have been very few sales, and the few sales that happened were all big homes. Then suddenly you will see a spike in the average price of homes sold in that month. So that's the example I would give to say that in a way, you can depend on the average to see the trend, but at the same time, you have to dig down inside to see what exactly drives those numbers in order to get a context and whether to leave out a particular month's data set or not. So overall, I think the question then will be, Raj, what is it that we have out here? So I have drawn out the conclusion, and the way I would explain is, what did we learn here? Well, pretty much we have heard what we already know. We got a little bit of details in terms of looking at data sets and infographics. And the conclusions I have is that we have to expect volatility in presidential elections. We are experiencing it right now. And we also learned that election years do not give great returns. But so far we have had spectacular returns, and which means that if election years do not give great returns, then the returns are going to drop going forward, which means the share price is going to continue falling until we reach election. And the next question is, do we have any clarity on what will happen next? Not at all. We still got only the VIX and the daily charts and economic data that will give us any idea of how this particular year will turn out. The data we saw is the average of all the years before. Overall, what is it that we can expect? We can expect rate cuts to start in September in order to prime the economy. Will it actually prime the economy? We have yet to see. I think the current drop in prices is possibly a buying opportunity for long-term investors of quality stocks. They could start a position in a coveted stock that they have always had. In my case, it's like Berkshire Hathaway, Walmart, maybe ExxonMobil. I could do dollar cost averaging so that my average cost of ownership of these stocks can be reduced, and as a result my risk will also reduce, and my dividend yield in these stocks will also improve because my cost of ownership is less. And because it's extremely difficult to time the market, it means that as a long-term investor I'll have a boring schedule, but I'll make significant money over a period of time. I'll have very less excitement and will have a resilient portfolio that can withstand massive corrections and still stay green. On the other hand, as a speculator, I'll have a tough life with prospects of losing everything. I am mostly a long-term investor with a small speculative part of my portfolio to provide excitement in an otherwise boring pursuit of long-term profits. I would like to leave you with this thought out here. Out here you are seeing the long-term map of S&P 500. Each of these candles is a monthly candle, and you can see that this big red candle in the month of September is causing us a lot of concern and heartburn. It seems like the whole sky is falling on us. But if you had to look at the entire trend of S&P 500, it's in a long-term bullish trend, and if there is a correction, there's got to be more drops to come, and we have the 9-day exponential supporting out here. So I would say that we should not panic too much, especially as a long-term investor. Same way, if you look at NASDAQ, even though we have a huge candle for September which is red and it's falling, we are still on a bullish trajectory, and the case for bullishness is not yet over. So that's the thought with which I would like to leave you. And if you're a long-term investor, you can relax, because it's only in the short term that you see so much gyrations. But if you look at a long-term period of 3 years or 4 years, I think it's peachy. Everything looks good so far. That's my opinion. I would be very keen to hear from you. What kind of investor are you? Are you a long-term investor or a short-term investor? Someone is looking for a lot of excitement, or someone who is steadily focused on the long term? Because if you're a long-term investor, this is the best time that is coming to us, because the PE is dropping, and most of the shares that you really like are going to come cheaper, and you could dollar cost average. Of course, these are all my personal opinions, not financial advice, but I would be very curious to hear what you think of this segment and what are your own thoughts about where we are going with the stock market. Thanks and have a great day. I'll catch up with you in the next video. Bye for now.